today's video, we're going to be diving into the question of does velocity banking work to pay off credit card debt? But before we do that, I'd like to quickly thank everyone who has subscribed to the channel as we are now above 1,000 subscribers. If there are any video topics that you're interested in around velocity banking or everyday finances, please let us know down below in the comments. And for those not subscribed, please consider subscribing if you enjoy this content and if you're looking to join a community focused on improving our overall financial knowledge. So when it comes to the question of does velocity banking work to pay off credit card debt, the simple answer is it depends. Different financial situations will greatly impact the extent to which it can work, and in some situations, it is just not a suitable strategy. So in this video, we'll be looking at different scenarios to determine which situations might be a better fit to use velocity banking. And be sure to stay to the end of the video where I share my own personal opinion on when I would personally choose to use velocity banking to pay off credit card debt. So when it comes to people with credit card debt, they can really be broken down into two different buckets: people without additional monthly cash flow and people with additional monthly cash flow. People in either of these situations can successfully use velocity banking, but again, the benefits and risk will vary greatly. Let's take a closer look. In our first scenario, let's imagine that I'm a person who currently has a credit card balance of $10,000 at an interest rate of 21% with a monthly minimum payment of $100. My monthly income is $4,000, but after paying all of my expenses, I am left with $0 in cash flow. Of my $4,000 in expenses, $3,000 can be paid onto my credit card. So I can use this $3,000 to implement velocity banking by taking it and putting it all onto my credit card. Then throughout the month, as my expenses come due, I will then use my credit card to pay these expenses. This has now benefited me in two ways. One, I have lowered my average daily balance as all my expenses will not be coming out at once, which will result in a lower interest charge. And two, I have now made $3,000 in additional monthly purchases on my credit card, which are typically eligible for a reward. In terms of interest savings, let's imagine that all of my $3,000 in monthly expenses comes out equally throughout the month. This will then leave my average daily balance right around $8,500. At an interest rate of 21% on my balance of $8,500, this will result in an interest charge of around $148.75. Now compare this to if I didn't use velocity banking and just made our minimum payment of $100. This would leave our monthly balance at $9,900, and the interest charge would be around $173.25. So by using velocity banking, I was able to save $24.50 plus my credit card rewards, which you will say is a 1% cash back, so an additional $30 a month. So in total, by using velocity banking with zero cash flow, I was able to save around $54.50 a month. Now, the key thing here is for the strategy to actually work to accelerate my debt repayment, I must use this $54 in savings to make additional payments onto my debt and not use it for additional unplanned purchases. So in this example, we can see that velocity banking definitely works, but does require a lot of discipline for a fairly small reward. So let's now compare this to our other scenario, which is if I am someone who has credit card debt, but I also have additional monthly cash flow. For comparison's sake, let's use the same numbers from our previous example, but the only difference being that my income is now $5,000, but I still have the same $4,000 in monthly expenses. Since these are the same $4,000 in expenses, $3,000 are eligible to be paid onto my credit card. So the big difference in this example is that I will now have $1,000 in additional cash flow, which will allow me to do two things. One, further lower my average daily balance, and two, make additional payments onto my credit card. In our first example, we saw that I had an average daily balance of $8,500, but my additional cash flow will now lower this balance by $1,000 down to $7,500, leaving my monthly interest charge right around $131.25, which is the lowest interest charge of all of our scenarios. So again, we can see that velocity banking with the credit card does work, but certain variables impact the extent at which it works. The two main variables that can have the greatest impact are one, the amount of expenses that I can pay onto my credit card. The more expenses that I can pay with my credit card, the lower my average daily balance will be. And two, the amount of monthly cash flow that I have. The more cash flow that I have, the more I can lower my average daily balance and make additional payments on my debt. So, in what situation does velocity banking not work to pay down credit card debt? Well, one situation is if I'm someone who doesn't get paid with consistent frequency. For example, maybe I'm a real estate agent and it is very difficult to predict when my next paycheck will be. In this case, using velocity banking can be extremely risky, as I might not be able to stay consistent with my payments and strategy due to my income not being consistent. Another situation where velocity banking will not work is if I'm someone who lacks financial discipline. Without financial discipline, the strategy will not work, as I am making additional payments onto my credit card, which then frees up additional room on my card. For people with spending issues, this poses as a significant risk, as I am likely to repeat my poor spending habits when given the chance. So for me personally, I would first focus on getting my financial discipline under control before ever looking at something like velocity banking. However, I would consider using velocity banking to pay off my credit card debt if I had a high amount of monthly expenses that could be paid onto my credit card, regardless of whether or not I had any additional monthly cash flow. This would allow me to significantly lower my average daily balance, save on interest, and receive a higher amount in credit card rewards. However, I would also be hyper aware of the risk of potentially making additional payments onto my credit card. If you found this content to be helpful, please give this video a thumbs up and consider subscribing to the channel for more content related to velocity banking and everyday finances. Thank you for watching, and we'll see you next time.